I'm Sebastian Mullins, Head of Multi-Asset for Schroders Australia. The market continued to rally this quarter, with equities up over 7% in local currency terms. US equities delivered around 10% over the quarter as people started to price out the view of recession and seeing more positive growth and more positive consumer spending. However, Japan was the standout, delivering around 22% in local currency terms this quarter. In terms of bonds, bond yields backed up over the quarter, as in the US, for example, market participants went from pricing in 150 basis points worth of cuts to around 80 basis points worth of cuts at the end of this quarter, which is around the 75 basis point guidance given by the US Fed. That made bond yields move up over the quarter, with the US 10-year Treasury yields ending at 4.2% and move higher around 30 basis points over the quarter, or in price terms, a loss of around 2%. Credit spreads tightened over the quarter, however not enough to offset the loss from the sovereign bond components, with US investment grade credit falling over the quarter, European investment grade credit around flat for the period, and Australian investment grade doing quite well, around 1.5% returns in local currency terms over the quarter. High yield did better, delivering around 1.5% in US high yield, but emerging market corporate high yield did the best at around 3.6% return in US dollar terms over the quarter. Currencies mainly moved because of the US dollar, with the DXY moving around 3% over the quarter, but the main move was the fall in the Japanese yen, despite abandoning yield curve control and increasing rates for the first time in around 17 years, saw the yen fall around 7% against the US dollar. And finally, in commodities, oil rallied around 14% from the low at the beginning of the year to the end of the March quarter. The Schroders ISF Global Target Return A-share class delivered 3.2% in US dollar terms net of fees for the quarter, which brings the one-year return to the end of March to 9.5% net of fees. Most asset classes added to performance over the quarter, except for duration and currencies, which attracted on the margin. The main contributors were equities, which delivered very strong returns over the quarter, followed by insurance-linked securities, high-yielding credit, and also securitized credit. Our allocation to inflation-linked bonds helped protect the portfolio as nominal bonds in the US sold off during that period. And given the strong rally in the US dollar, most of our currency exposures detracted, but only on the margin. Markets spent most of last year discussing whether or not we'll have a hard landing. As we come into 2024, the narratives move from whether we're going from a hard landing or to a soft landing. The question we have is, should we be talking about a no landing at all? Because economic growth continues to surprise to the upside, especially in the US. If you look at this slide, you can see that economic growth was starting to fall in the US towards the end of last year, but it's since started to recover pretty aggressively since then, without inflation really picking up dramatically. One of the expectations last year was at the end of having rolling recessions, since COVID-19, we saw manufacturing fall into recession as services did really well after the reopening. The idea was, after very high rate hikes, especially in the US, that spending on services would start to roll over and services will join manufacturing in recession, the hard landing. However, as you can see on this next slide, on the right-hand side, the belief that manufacturing ISMs are going to start increasing in the coming months. What we look at is new orders minus inventories to give us a lead on where that metric may end up. And as you can see, it's moving above 50. So rather than services catching down to manufacturing, we're seeing manufacturing catching up to services. And if we look at the flash PMI from S&P, the current manufacturing service flash PMI is 52.5, or the highest it's been in 21 months. So we're starting to see a broad-based recovery. So rather than a no landing or a soft landing, maybe both of these sections are actually accelerating together, having a synchronized upturn, which could lead to the no landing scenario. This has caused our economic team, who on the left-hand side show our view of what we think US growth will be this year. Originally, the view was that GDP growth in the US would be 1.3% this year, but our economics team now suggested 2.7% GDP growth this year, a far bigger upgrade than expected. And that's how we shifted our view from being a soft landing to most likely a no landing in the US. However, while that'd be good for economic growth and potentially equities and risk assets, it does put pause on the expectation of aggressive rate cuts from US central banks. Here on the left-hand side, you can see that the market is now pricing in 75 basis point cuts this year, which is in line with our expectation and also the Fed's expectation through their guidance. That might also be a little too much. We're starting to think the market might move to price only 50 basis point cuts this year, which would be a buying opportunity. However, if you look further out on the right-hand side of our graph, expectation for cuts in 2025 still look pretty optimistic. We do not believe they'll cut as much as the market expects over the next 2 years. And for those reasons, we're more dubious on buying duration, but would like to trade the range as those expectations shift throughout the periods. We still remain pretty positive on equities. Now, equities have moved pretty far, and people are discussing how expensive markets like the US have become. The US hits all-time highs, and even Japanese equities have hit the all-time highs. But earning growth assumptions are still quite strong for these markets, and our top-down macroeconomic models agree with these earnings expectations looking forward. So we do not believe that these expectations further out are too stretched. And if you look at this graph here, you can see that upwards revisions, that is analysts improving their view on earnings looking forward, continue to be strong for the US and Japan. That's why we prefer US and Japanese equities within our equity allocation. We are overweight US equities because of the strong earnings growth and the strong US economic backdrop, and we like Japan because of its relative cheap valuations, at least compared to the US, and structural tailwinds from structural reforms in corporate governance, and also potentially a boost from technological advances in robotics and AI. We continue to increase our allocation to equities over the quarter, adding around 7% and having 37% at its peak during the quarter. However, we sold some of that at the very end of March, bringing our current allocation down to 33% in equities. We enjoyed a very strong rally in US equities and Japanese equities, which is where we were positioned. So we're just trimming a bit of that on the margin to take profit because we do believe that sentiment and positioning has been stretched in the market. To fund those allocations throughout the quarter, we did reduce our allocation to credit. Credit spreads contracted quite substantially this year, and we've now taken profit on that by selling around 7% in US investment grade credit and 2% in global high yield. Within global high yield, we moved around 2% from US high yield to European high yield, where spreads are more attractive. We don't believe spreads will widen anytime soon, but given the compression, the best you can expect for now is carry, and we prefer to take upside optionality in the equity market. We added to commodities this quarter. We added around 2% to commodities in January and 1% to energy equities as well in January. Our belief there was that the market had not moved to price in a higher for longer scenario, and commodities were the last asset class to reprice for the soft landing or no landing scenario. And also these allocations help protect the portfolio if inflation is hotter than the market expects. Under the surface, we changed our allocation to duration over the quarter, adding a quarter of a year to duration at the end of March. Under the surface, we did quite a few trades with options. At the start of January, we sold some volatility on treasury yields, expecting volatility to fall after the January FOMC meeting, which is what occurred, allowing us to capture some premium and add income into the portfolio. We then used that to buy a put option on US treasuries. So as yields backed up over the quarter, we were insulated and made a profit, I should say, by having those put options in place. Once yield backed up higher, we took profit on those put options and then bought more duration, which is why we now stand at 2.25 years of duration. In equities, we continue to hold put options, put spreads, to protect the portfolio from 5 to 10% drop in the market. We don't believe that equity markets are in for a huge correction. However, sentiment and positioning is quite stretched, so a pullback would be natural. And we're protecting the portfolio with those put options and look to buy on the dip if that arises.